Newly updated inflation prints are out, and while future rate cuts are anybody's guess, it's now very evident that the last rate cut that we did in Canada did not bring out the buyers. Instead, it actually brought out a ton of sellers into the marketplace. Inventory is spiking in Canada's major cities, and well, the unemployment rate is going along with it. We are going to dive into all of this today, pointing out what we find the most important elements about Vancouver real estate this week. And first off, if you're considering making a move in this real estate market and you're not quite sure the best way to navigate it as things are moving quick and policies are changing and it's almost new every single day, well, please book a call with us and we'll listen to your goals and help devise a plan together. Now let's dive into what happened this week in the economy and in the real estate market and all the things that are going to affect what's happening with real estate here. Inflation in the US dropped. They brought out their June report just this morning, actually. It dropped 0.1% down to 3%. And for the states, that's actually the lowest inflation print they've seen in 12 months now. If you remember, it was exactly 2 years ago in June when it was 9.1%. It's a very different landscape we have now. But their Fed, Mr. Jerome Powell, was quick to note that obviously inflation hasn't been beaten there yet, and they're going to need a lot more quote unquote good data to basically help enforce any chance of rate cuts there. The Feds, they usually kind of say these statements to protect themselves to either decision, but that's sort of the official statement. And they do have an announcement coming up in this month, July 31st to be exact, is when the Fed will be making their next rate announcement. Of course, the markets they're not expecting a cut. They don't think the Fed is going to cut until September at the earliest at this point. While here in Canada, well, we've also got a rate announcement this month happening on July the 24th. Now, last month's inflation print of 2.9 that we saw here in Canada was a lot higher than the expected 2.6%. And that, of course, instantly had markets pushing out any chance of a cut here or a second cut here till at least September as well. But there's something that we want to make very prevalent to everyone. And do you remember how we talked about how StatsCan had changed the composition of their formula of how they calculate the CPI basket just last month? Well, that rejigging of it, if you will, that recomposition was actually largely responsible for the higher than expected CPI print. You see, mortgage interest is still contributing a whopping 1.3% to that total 2.9% inflation rate. Meaning if you add up everything else, it comes in at just 1.6. With the shift in the basket weights and the rate cutting cycle underway, and with that 1.3% being completely controllable by reducing the interest rate, well, July's announcement will likely surprise everyone, no matter which side of the fence you may be on.
It's certainly feeling like it's 1.3% in the economy. Everywhere else that we're looking, it's just not great here in Canada when it comes to that. And it's my personal belief, I believe that the Bank of Canada will carry on the path that they're on right now. Whether that's a 0.25% cut, that's kind of where I'm putting my money. I think we'll continue on because not much has changed in terms of affordability for all Canadians and also those looking to buy a house. Not just, 0.25% doesn't do much. And when you consider what we're about to get into here in terms of the stats and the performance of local real estate markets, it's eye-watering. So I feel that the Bank of Canada is going to continue down this path. And much like you said, Dan, I think it will surprise people as we continue to go forward, but we'll see. What's also very interesting is a couple of days ago, there was a news story that was released here by Better Dwelling. And it states here that Canadian households are reducing consumption to pay their debt. And this report, while it came out from that news source, was actually a study completed by the Bank of Canada. So hear this out. And listen, some of the numbers that are coming out of this report, I have to give them a bit of a scratch on the head because I look at my own financial situation and then I compare it against what's happening in this report, and it just doesn't line up. So we'll see. So get this. Researchers have shown they anticipate rates would have been 2 points lower than where they were observed at the peak when they made this forecast back in 2022. And the reason that rates are much higher than where they thought rates would end up going is due to an incorrect call on the transitory inflation and liquidity issues from excess government spending. The BOC estimates that higher mortgage payments have reduced mortgage borrowers' overall consumption by at least 3% since 2022, though that is expected to rise now to 5% by 2027. And all of that money that is going to be paid by mortgage borrowers against their debt is going to come out of their savings. It's not going to come out of their income. So this means that Canadians are likely getting poorer trying to hold on to the very assets that cover their heads. The BOC has estimated that the average mortgage payment in Canada has climbed 9%, only 9% since 2022. And what's more is that it's likely going to double to 17% by 2027. Well, that's kind of interesting to hear that data, but they might want to look at those numbers again. Because when I look at my own variable rate mortgage scenario here, and I calculate the payments I started with versus where I'm currently at right now, and my own personal situation has swung by 61% year to date. And that increase has largely been all interest payments. So to also give you some perspective, when I got my mortgage, it was sort of this 60% principal reduction payment and about 40% interest cost. That is now completely swapped. And I'm looking more at a 70% interest payment and 30% principal reduction. So I don't quite, follow a lot of what this report is saying because, perhaps they're considering a lot of fixed mortgages as well. But nevertheless, the numbers seem incredibly low. Another really interesting sort of data point that came out of this that I think is worth talking about is that it suggests that the knock-on effects of a rate hike cycle will last far longer than the rate hike cycle itself. And that we know to be true. For every rate cut or every rate hike that we go through, it typically takes 4 to 6 quarters for that rate hike or cut to find its way through the economy. Don't take it from me though. This is verbatim out of the report. So I quote, "These increases reduce mortgage borrowers' consumption for 2 reasons. Their mortgage payments increased during the rate hike cycle, and they will face higher remaining balances to be paid off in the future. Because a rate hike cycle will increase the total debt burden of the mortgage borrowers. The negative effects of a rate hike cycle on mortgage borrowers, consumption will last longer than the rate hike cycle itself." So here we find ourselves with young people, young families who would have bought a home in the last 5 years that are trying to get their families ahead only to face higher amounts of mortgage debt owing than when they first purchased their home.
These numbers definitely sound light to me. Pulling back only 5% in your spending just to cover mortgages. There's data that definitely speaks elsewhere to this, but whatever. It's a data point, and we take multiple data points to really be able to provide at least our vision.
I think too, what's insane, Dan, is that this report came from the Bank of Canada itself, right? So that's what's kind of bananas about this. Certainly maybe in other parts of the country where Vancouver or Toronto, where, your lifestyle is far more expensive than, say, living in Winnipeg. But nevertheless, there's a density relationship there too. There's far more data points in these major metropolises than across the rest of Canada. So I'm with you on this. I don't think these numbers are reflective of what is actually taking place in the economy.
Yeah, Bank of Canada, it obviously has a lot of people asking questions, especially after, low forever and then transitory and all the other claims over the last 4 or 5 years or so. And especially when their mandate is essentially to keep inflation around 2%-ish. And if we remember, while inflation was spiking, they waited all the way until it was over 6% to start increasing rates. They had almost a half a year, more than like 3/4 of a year of data saying they had to increase rates, but they took that long. So I don't know, not a shot at them. I'm sure there's a lot going on behind the scenes, but still, when their mandate doesn't equal their actions, it raises questions.
And you end up losing a lot of faith in financial institutions or government institutions as a result. I think if you look back over the last 5 years, there's been a huge drop in the belief system or the trust around these institutions, and they're getting things wrong over and over again. So again, another report like this paints a rosier picture than I think the reality is on the ground.
Well, one thing the Bank of Canada is definitely looking at is the employment rate, and it's becoming an issue in Canada and fast. And I believe it's about to get much worse, much quicker. June data was out and it saw jobs month over month drop 1,000 in Canada. And that was well below the expectations, right? It's expectations versus reality that really kind of pushed the needle here. Expectations was a net 25,000 new jobs in the country. So we've got aggressive population growth combining with these softening employment trends. Well, that's now pushed the unemployment rate up to 6.4%. That's up 1.6% from the post-pandemic lows. Unemployment rate has been increasing for about 2 years straight now. And if we pull out the bizarre spike that was the pandemic, we're currently at a 7-year high in that unemployment rate, a 7-year high. The construction industry is getting hammered. I mean, sorry, no pun intended, but it's getting severely beaten down right now. It's down 3 months in a row and about 3% during that same stretch. With all these new projects being shelved, with these towers going insolvent, with a lot of developers just kind of pulling back, you're going to see that construction industry unemployment rate definitely continue to increase. And it kind of gets worse here because when we look at the last 3 months of the employment data here, almost 100%, like 99 point something percent of all the new jobs that were created were part-time. What's more, if we look at the hours worked, this metric is very important to the Bank of Canada as it directly affects GDP. Well, that metric is up only 1.1% on the year, despite and in relation to a 3% population growth. The labor market is completely unable to keep up to this current extreme rate of population growth. And the employment rate, well, that's now dropped to 61%, which for reference is lower than it was during the global financial crisis and is the lowest it's been in 20 years. Not good. Pre-pandemic, for reference, is about 63%. So that kind of gives you an understanding that, yes, it's 2%, but yes, that 2% drop is the lowest it's been in over 20 years here. And just a quick clarification when it comes to these two metrics, unemployment rate is the share of active job seekers that are unemployed. The employment rate is the share of our total population, including retirees, that is currently employed. So those are how those two numbers relate to what's going on here. So even with a 20-year low in the employment rate, the job vacancies, well, they're also dropping. Do you remember back in 2022 when we discussed how there were 1 million vacant jobs in Canada? And, partially due, I think, to why they opened up the floodgates and brought in so many people because they needed them to fill these jobs. Well, that number has almost been cut in half. It's down to about 575 job vacancies across this country right now. Understandably, that reduction in available jobs is driven largely by the amount of businesses going out of business and the ones that are currently delinquent in their payments, because that metric is absolutely surging. The typical delinquency rate hovers around 0.4% when it comes to business debt. And it has shot up almost vertically and is sitting at 1.5%. More than 3 times its current rate. And again, surpassing that global financial crisis. And I don't know how many people remember the real estate market during the GFC, but it was crickets. Slow, slow, slow. And now we've got all these metrics that are surpassing as like the extremes of how quote unquote bad it was during the GFC, which means moving forward, there's a lot of indicators here stating the likelihood of a continued slowdown in the real estate market here. And just a quick comparison when we're talking about that delinquency rate at 1.5%, in the States right now, their small business insolvency rate's at like 0.6. So they're less than half, and it's increased, but it's somewhat stable. So clearly, as businesses go insolvent, people lose their jobs, lines of credit card payments get missed, and that will trickle down to real estate next.
Starting to smell like the R word, Dan.
No, I was just going to say, it has for years. And of course, on a per capita GDP, we've been there for about 1.5 years in a recession. When will Canada admit it? That recessions sometimes are view mirror looked at, meaning that they won't say we were in a recession until we're almost out of it. But again, we will let the powers that be claim it by their own metrics.
You know what else is interesting when you talk about going back to those part-time jobs that were created, and almost 100% of them were part-time. I would love to know, and this is why some of this information, you can't just take it at face value. I'd love to know of that 100% part-time job growth, how many of those part-time jobs were taken by people with full-time employment just to make up for the lack of what their current job is able to offer them. It's very interesting because these are huge indicators that tell us whether or not we're actually creating new things. Whether, I just don't get the feeling that it's just a bunch of summer students that have signed up for part-time jobs. I get the impression it's struggling families who are taking on additional levels of work so that they can get through these tough times. That is reflected in the downward GDP per capita that we've been seeing. And I'm more likely to believe it's that than it is just a function of a seasonal job change. Anyhow, moving on now, let's look at Toronto condos, because this story is bananas. Some of the numbers coming out of the Toronto market are, albeit scary. So Toronto home sales actually increased in the month of June, which was great. Month over month, it was up about 4.5%, but that was still the lowest June in terms of sales in 24 years. It's down 16% year over year and down 28% for condos alone. The rate cut, like we talked about earlier, that thought would bring back many buyers to the market, did quite the opposite. And we are seeing a number of sellers and investors that are offloading properties at an increased pace. In fact, when you consider the total inventory in Toronto, it's up 67% year over year. And when you pull out condos are up 84%. This is the highest inventory we've seen in 14 years. With hundreds and hundreds of more units hitting the market as new buildings are continuously completing, it's likely you'll see prices race to the bottom for much of 2024 in this segment. Investors have been completely sidelined, and it'll take deep discounts to get them back to the table. And here in Vancouver, in BC, we're going to need to see more in terms of regulatory change to get them back here. It's become a hostile environment in Canada for investors, whether you're in Toronto's market or whether you're in Vancouver's market, and for a number of different reasons. The monthly condo cash flow index has been improving a little bit since bottoming out in 2023, but still, the average condo is running cash flow negative each month to the tune of $1,000.
Not very attractive, and pretty hard to make an argument for an investor to put capital into a condo these days, especially in BC with all the new changes. And let's shift to BC, Vancouver specifically, on that same inventory conversation. By the time you're watching this, GVRD, our Greater Vancouver active inventory, will have surpassed 15,000 active listings. And it's the highest it's been in 5 years. Now, sure, Toronto has a 14-year high in active inventory and Vancouver 5. Very different markets, right? Well, they're getting a little bit closer in the sense that it'll take an only additional 700 active listings here in Vancouver to suddenly hit a 10-year high. A 10-year high. And honestly, I fully expect that to happen this month. It won't wrap up there as all the delistings happening at the end of the month, but there's going to be a stint here during, the last half of July where buyers in the landscape will have more homes to choose from than they've had dating back to 2014. It's very interesting, though, to note that condos and townhomes are at 4-year highs today for inventory, but it's actually detached homes that are leading the race, currently at a 5-year high in active inventory. And I find this interesting because it's at the same time that this inventory is interesting. Single family home housing starts are at a record low, dating back as far as the stats go, the information goes, is 35 years. So new home starts are basically non-existent, and yet we're seeing a very interesting spike in single family homes that are available on the market. I believe the spike will be short-lived in relative terms because, they're going to start getting eaten up, especially with the Plex plan in place now. But I do fully expect these condo listings to spike over the next quarter or so as the new regulations all but destroy the appetite for investment condos, and current owners are going to try to offload these before things get worse in that segment. But getting a little bit more specific in this comment, I just wanted to share a quick little story here about how markets are almost becoming hyper local. I mean, if you look downtown, for example, the condo market there price-wise has been flat for basically 6 years. There are prices today that are exactly where they were in 2018. But if you just cross over the Granville Bridge into Fairview, well, guess what? Those condos are actually trading at an all-time high. They're up about 17% since that same 2018 era. So when I say things are spiking or they're going to get bad, it really can be hyper local because, of course, what's happening in Fairview is going to be different than what might even be happening as close by as Olympic Village. So if you're thinking about making a move, obviously get the information about exactly the area, the city, the block, the building that you're in. But again, we kind of talk top level because we like to discuss GVRD as a whole. Let's talk quickly about the mortgage arrears rate in Canada. This is the amount of mortgages that, of course, are 3+ months late in their payments. That metric, it hit an all-time low back in September of 2022, basically when everyone was cash rich. And it understandably has been increasing ever since. That is until the month of April. So April of 2024 actually saw the arrears rate in Canada drop. It improved. It went from 0.19 down to 0.18. You heard that right. So nationally, what does that mean? It's about 100 mortgages came out of arrears in that month. So surprising for sure, because I personally said it was definitely going up in April. I was wrong. It improved. Good chance that's an outlier. And we are going to see that start to tick and sort of grind slowly upwards again once that May data comes out. But it's like yet another data point, another metric that shows just how resilient Canadian housing is and that people are still doing everything they can to pay that mortgage first and get themselves out of insolvency. Maintaining near record low insolvency rates that are basically, we're 8 times better than the current rate in the States. And they've got those 30-year fixed term mortgages. So Canadians, they're holding strong to their homes and, the proof is in the pudding, as they say. Ryan, final thoughts?
Yeah, I much to your point, I believe that the April data concerning mortgage arrears is a blip on the radar. Much like we kind of talked about earlier in the podcast here, a lot of Canadians, their disposable income, the things they would be spending on other things in the economy, which would help grow the economy, are being reduced because they are servicing much higher debt when it comes to their interest payments on their homes. So it doesn't surprise me. That has always sort of been the case when we've gone through these cycles in the past. And it seems like Canadians are doing the same thing again. Though, much to your point, I believe the affordability rates now are more extreme than they were then. So we will likely continue to see this rise. I also think we'll likely see Canadians flock to more affordable places. I think, Alberta, Atlantic Canada, you're going to see people move away from Toronto, move away from Vancouver because of the unaffordability elements that exist in the marketplace. And until we get some relief, some real relief from the Bank of Canada, it's going to get worse before it gets better.
There you have it. That is it. That's what's important this week in Vancouver and Canadian housing. Thank you so much for tuning in, and we look forward to seeing you here next week.